To everybody who's new to the channel, thank you for subscribing. I appreciate the support. And Ike here. Welcome back to Live Richly, where we talk everything personal finance. Today we're going to be talking about passive income and dividend investing as a way to achieve passive income and the problems I have with that strategy, especially if you're a young person. All right, so let's get into it. I've been researching passive income, right, to make a video. It's a very popular topic on YouTube and I'm trying to get those views. And one thing kept coming up over and over and over again as a strategy to achieve passive income. And this was dividend investing. And I really don't think you should be investing for dividends, especially if you're a young person. And I'm gonna explain why in this video. So we're covering 4 things. Number 1, what is passive income? 2, dividend and dividend investing as a strategy to achieve passive income. 3, the issue I have of investing for dividends if you're a young person. Number 4 is going to be a tip on what to look out for when you're looking for companies to invest in. I'm all about saving you guys time and money. I've included timestamps in the description of this video, or it should be in the timeline, so feel free to skip through the section that you feel is most relevant to you. But I ask, if you get any value from this video or find this video entertaining in any way, please hit that like button. It really helps support the channel. Also consider subscribing. I'm hoping to get to 100 subscribers before the end of October, and maybe share this video with anyone who you think might get value from it. All right, cool. So let's get into what is passive income. Right, there are 2 types of income. There's active income, which is money earned in exchange for performing a service. So consider something like an hourly wage or the salary that you receive. You're essentially selling your time for money. Then passive income, on the other hand, is actually derived from little to no effort and requires minimal effort to maintain it. That doesn't mean passive income is easy to achieve or easy to get. In most cases, there's usually a lot of effort taken at the beginning of the process and very little work done to maintain that income ongoing. So for example, something like rental income or income from your rental property is passive income. So you would have spent a lot of time researching and buying the property, but as long as that property is rented out and you're receiving an income from it, that's passive income. But there are different effort levels when it comes to passive income. But for simplicity, this definition will suffice for this video. So now we know what passive income is. Let's explain dividends and dividend investing as a strategy to achieve passive income. So what is dividend investing? So when a company makes a profit, it has 2 options available to it. You can reinvest that profit back into the business and use those profits to stay competitive by investing in research and development, or it can grow the business by acquiring other product lines or other businesses, right? So think of Apple spending billions of dollars in research and development, or Samsung spending billions of dollars to develop a foldable phone, or now they're working on a phone that's transparent. Or think of Facebook buying an Instagram or WhatsApp. These are companies that are using the profits that they're getting to reinvest in themselves, right? The other option would be to distribute those funds to the owners of the business. That would be us, the shareholders. So as a shareholder, we are entitled to that dividend for as long as we hold those shares. So dividend growth investing is an active investing strategy which involves buying and holding a portfolio of companies that pay a high reliable dividend. So as a dividend growth investor, you build a portfolio by looking for companies or exchange traded funds with a track record of paying a reliable, high growing dividend. So for example, if you're a dividend investor, you'd buy shares in like an excellent company like a Coca-Cola, ticker code KO, which is one of Warren Buffett's favorite companies. And it's been paying a reliable dividend of 3.3% for years now. And that's not bad when the alternative investment is cash. So the beauty of dividend investing is that you can use the dividends that you receive to buy more dividends. And then you get more shares, which means you're entitled to a higher dividend next year. Then you can use that to get more shares, to get more dividends, and compound your wealth that way. So from a passive income perspective, this seems like a no-brainer investment to make. You do all your work in the beginning of the process, researching the companies, and you don't do anything else apart from wait for your dividend checks to start rolling in. But here is where it gets a bit interesting. So what type of businesses pay a reliable high dividend? A dividend paying company in most cases is a mature business that doesn't need to retain those profits to reinvest in itself, as we've mentioned earlier. These types of businesses are very profitable but aren't growing fast. So the issue I have with dividend investing as a strategy for young people to achieve passive income is, have you considered the opportunity cost of investing in a dividend stock as opposed to a growth stock? And opportunity cost is the cost of the decision that you didn't make. So now let's explain opportunity cost of dividend investing by way of example. So now let's say back in September 2010, you put $10,000 in Coca-Cola and it's paying you a reliable dividend of 3% and you get some capital growth on the side of 6%. So on average, it's compounding at 9.58% for that 10-year period, which is actually a really good return. So over that 10-year period to September 2020, your $10,000 investment would have grown to $24,917. So this is actually a really good investment. You've invested in a blue chip company, Coca-Cola, paying you a reliable dividend of 3.3%, and you've more than doubled your money in a 10-year period. Now let's look at the opportunity cost side of things. Now let's say if you had invested in another quality business that is growing rapidly but not paying a dividend. Something like an Amazon that has never paid a dividend, by the way. Your $10,000 investment would have compounded at a rate of 35.44% and would be worth $207,000. So as you can see here, your dividend paying stock is paying out a lot of its profits to the shareholders. But if you invest in growth companies that are reinvesting that money back in themselves at a way higher rate of return than you could get if you were investing that money, you'd be way better off in the long term. So the way I think about it is, when I get a dividend check, do I think I can get a better return than if this company keeps this money and reinvest it in themselves? So this is not financial advice because I haven't taken your personal situation into account here. But dividend investing is a strategy that's suited to retirees, people who aren't working anymore and need to replace the income they were getting when they were employed. If you're a young person, you don't want to be looking for income from the investments that you're making, unless you need that income to fund your lifestyle. But typically you're looking for high growth, you're looking for capital appreciation. You're looking to invest in those companies that are going to get you a higher return than if you were investing that money. Because you want a Facebook or an Amazon to work for you. You're going to invest in them and you want them to keep investing in themselves and generating you a higher growth. That's why when you buy a share in a company, you're not just buying a ticker symbol. You're buying part ownership of that business, and you're entitled to any growth that that company makes. So please consider this when you're thinking of generating passive income, or if you've watched a specific video on YouTube where they're recommending young people invest in dividends. I think it's tomfoolery. Now for the tip of this video. If you're a young investor, and by young investor I mean someone who's younger than 55, and you're looking for like growth companies, you want to be looking for companies that have a high ROIC, or a high return on invested capital. And this is a ratio which shows you how effectively a company invests its profits back in itself to generate a return. So if you're looking to grow your wealth and you have a long time horizon, you want to invest in companies that are still growing and have a place in the future. And most of these companies don't pay a dividend. Instead, they reinvest the money back into themselves to keep growing. Please consider this when you're looking for passive income and factor in the opportunity cost you're paying. Because from a cash flow perspective, kind of good to see those dividend checks coming in to your bank account. And also, a lot of people like telling other people how much they're making passively, or just that idea of money coming into their account and they haven't done anything, and it's based on the stocks they've picked. People like sharing that information. Just factor that in. That price you're paying for that dividend check that's coming in regularly is the capital growth you're missing out on those growth stocks that the rest of us are investing in. With that said, again, please subscribe if you got any value from this video or were moderately entertained, or if you learned something. So hit that notification bell so you know when my next video drops. So I think I'm gonna go down to a weekly format instead of 3 videos in 1 week. This has been a bit crazy, but to all those people who are telling me to post more on Facebook and on Instagram, you can now enjoy me in glorious 4K. So on that note, please take care of yourselves, take care of each other, and don't forget to call your mom. Okay, peace.